Your side hustle isn't worth what you think it is, and the IRS has already claimed 70% of it before you even sign the contract. Every year, professional athletes sign endorsement deals worth tens of millions of dollars, and almost every single one of them walks away shocked by what they actually keep. A $10 million endorsement deal sounds life-changing, and it is, just not in the way you think. Here's what nobody tells you up front. That $10 million isn't income in one state, paid once, taxed once. It's a moving target that gets hit from 4 different directions simultaneously. First hit, federal income tax. At $10 million, you're deep inside the 37% bracket, gone before you blink. Second hit, state income tax. California charges 13.3%. New York takes 10.9%. And endorsement deals are taxed wherever the commercial airs, wherever the appearance happens, wherever the brand event takes place. That's called Nexus taxation, and most athletes have never heard of it. But that's not even the strangest part, because Nexus taxation means you might owe taxes in 15 different states for one single deal. Third hit, self-employment tax. Endorsement income isn't a salary. It's business income, which means you owe an additional 15.3% on the first $160,000 and nearly 4% on everything above it. Most athletes and most freelancers completely miss this. Fourth hit, agent fees, management cuts, and legal costs. The standard take in professional sports is 15 to 20% off the top. That money is gone before you ever see it, and you still pay tax on the gross amount. Run the real math. A $10 million endorsement deal in California with standard representation leaves you with roughly $2.80 to $3.20 million. That's a real effective rate somewhere between 68 and 72%. The headline number and the real number are almost unrecognizable. Now here's why you should care, even if you will never sign a sneaker deal in your life. The exact same mechanism destroys a $500,000 side hustle. Freelance income, consulting contracts, creator revenue, selling an online course. All of it is business income. All of it gets hit by the same 4-layer structure. A $500,000 side hustle, after federal and state income tax, self-employment tax, and platform or agent fees, lands at roughly $150,000 to $180,000 in your pocket. You worked for $500,000. You kept less than $200,000. The trap isn't that taxes are high. The trap is that most people plan around the gross number instead of the net. They make spending decisions, lifestyle decisions, even career decisions based on a number that doesn't exist. Smart athletes and smart high earners do something different. They convert self-employment income into S-corporation income, which legally eliminates a significant portion of self-employment tax. They negotiate deal structures that shift income across tax years. They build deductible business expenses into their operation before the income hits. These aren't loopholes. They're the rules, written into the tax code, available to anyone who learns them. The difference is that wealthy people pay someone to know them. Everyone else finds out too late. The single most expensive financial mistake most high earners make is not investing badly or spending recklessly. It's failing to structure income correctly before it arrives. You cannot fix a tax problem retroactively. The clock starts the moment you sign. The IRS doesn't care what your contract says. It cares what you actually understood and whether you were ready. Most people aren't. If this changed how you think about your own income, subscribe, because this is exactly what we do here. And tell me in the comments, did you know self-employment tax existed before today?